Hello once again, and welcome to Ask Michael Anything. I'm Kevin Turner from Real Estate Talk, and we say hello once again, as we always do, to Michael Yardney. Hi, Michael.
Hello, Kevin.
Michael, a question this time from Emma Hunter, and thank you very much for the question, Emma. Emma writes, I keep reading that the banks are making it harder and harder for property investors to get a loan. I'm hoping to buy my first investment property later this year. Is there anything that I should do to increase my chances of getting a loan or maximising the loan that I get? Michael.
Thanks, Emma, and congratulations for now getting into the property game. You're right, it is much harder for investors, more so than homeowners, as APRA are tightening the screws, making the banks increase serviceability requirements. But the good news is the banks will prefer you to an investor with 3 or 4 investment properties. What they're currently doing is measuring your serviceability. That's different to affordability. You may be able to afford to pay the mortgage, but they want to understand if you've got multiple loans against multiple properties, that you could handle it if interest rates went up and if you had to pay principal and interest. So those investors who've got substantial portfolios are currently having a harder time than beginners. Having said that, there are still definitely things you should do to get yourself in the right position to make yourself favourable with the banks. Firstly, save as big a deposit as you can. To do that, you've got to spend less than you earn and keep saving. The other is get rid of any other bad debts, because banks look at your credit card debts, your store cards, and even if you haven't got debt against them, just the limit, because you could go off and tomorrow buy something big on your credit card and then have the commitment. So lower your credit card commitments, maybe by getting rid of an extra card or 2. A lot of us seem to have more than one card. As well as that, get rid of any other bad debts, pay those off if you can. Then don't try and do it on your own. It's just too hard. If you go into one bank, they're only going to tell you their products. So go and see a proficient finance strategist. Now, finance strategists are a bit different to a broker. They're going to think strategically ahead, not just for this loan, but for other loans. And they're going to help you through the maze of all the loans, all the different products. It's just too confusing. It's worse than phone plans, Emma. And the good thing is that won't cost you anything, because they are paid by the bank on results. So if they can't get you a loan, they're not going to get paid. Maybe you could, when you look at the loans, see what do you want, what do you need, what bells and whistles do you want. Maybe you're going to want a longer loan term, which may make it easier. Maybe you can get somebody to help you get going by getting your parents to either give you a bit of money or guarantee the loan if you're going to have difficulty doing it on your own. The other thing, when you go to see the mortgage broker, have all your paperwork ready. Have your tax returns ready for previous years, your pay slips ready. Make it easy, make it all nice and clean to make yourself attractive to the banks. The banks are money shops. They do need to lend money to keep in business and to pay their shareholders. So they want to lend to good investors and homeowners who are going to be able to repay their debts. Good luck with the property journey, Emma.
Michael, just before I let you go, just one other thing, if I could ask a dumb question on behalf of Emma. Not that Emma's asked a dumb question, but I will. Just talk to me about buffers for a moment. How does a buffer work, and should Emma, is it going to demonstrate to the bank that she's really thinking this through?
Thank you very much, Kevin, because that's a good point that I should have mentioned to Emma, that be prepared by having sensible budgets, because if you suddenly buy a $500,000 first investment property, you're going to have all those acquisition costs up front that the banks don't often mention to you. And that's why I talked about having a proficient mortgage specialist to help you to have the extra costs. The additional cost of, the first few weeks the property may be vacant, there's going to be rental fees, there's always little maintenance as well. And that's what Kevin was hinting at, that you have to have some money up your sleeve. When you first start in the property market though, Kevin, it's really hard to have a big buffer, because you really don't have much choice. You don't have extra deposit laid aside to put in a buffer. You don't have a house necessarily to have an offset account against. So therefore, you really do have to do your budgets carefully. But your point, Kevin, that all property investors should have something up their sleeve in a line of credit, in some extra cash, in an offset account to see for the unforeseens, will help you get through those difficult times, which we all inevitably have, don't we, Kevin?
We sure do, Michael. Thank you very much for answering that so well for Emma too. And Emma, I want to thank you for sending the question, and keep them coming in too. Just send them in through the website. or you can go to Michael's website, of course, Property Update as well. Michael, thank you. We'll catch you again next time.
Thanks, Kevin.